Right now, at this very moment, while you're sitting there watching this video, something is happening in the silver market that the financial media will not tell you about until it is too late. I'm not talking about a chart pattern. I'm not talking about a technical indicator. I'm talking about something you can verify yourself right now in real time with your own eyes. Open a new tab. Go to any major bullion dealer website. Try to buy a 100-ounce bar of silver. Go ahead, pause this video, try it, and come back. Because what you are going to see, what thousands of people have been seeing all weekend, is either a website that is down for so-called maintenance, a buy button that is grayed out and unavailable, or a price so much higher than what the futures market closed at on Friday that you will do a double take. That right there is the most important signal in the precious metals market right now. And if you stick with me for the next 16 minutes, I'm going to show you exactly what it means, why it matters, and what history tells us comes next. Welcome back to Silver Trends. Hit that like button right now before we go any further. Because what I am about to share with you is exactly the kind of information that gets buried by the algorithm. Every share helps this reach the people who need to hear it before Monday morning. So let me start by asking you a simple question. What is a price? Seriously, what is a price? At its most basic level, a price is what happens when a buyer and a seller agree on a number and a transaction takes place. That is it. The buyer wants the thing, the seller has the thing, they shake hands on a number, and the deal gets done. That is a functioning market. But here is what is happening right now in the silver market. The buyers want silver, the sellers have silver, and the sellers are saying no. They are literally refusing to sell. And when a seller refuses to sell at the posted price, that means one thing and one thing only. The posted price is wrong. The sellers know the real price is higher, and they are not giving away their physical metal at a number they know is a fiction. That is not a market anomaly. That is a market telling you the truth in the loudest possible way. And the truth it is telling you is that the paper price on your screen, that $67 spot price that the algorithm printed on Friday afternoon, is completely disconnected from the physical reality of the silver market in 2026. Now, let me give you the data, because this channel runs on data, not hype. The COMEX, which is the exchange where paper silver futures are traded in the United States, reports something called registered inventory. Registered inventory is the silver that is actually sitting in approved vaults, physically ready to be delivered against a futures contract. As of the most recent reporting, that registered inventory stands at 88 to 191 million ounces. Now I need you to understand what that number means in context. Back in October of 2025, just 5 months ago, total COMEX silver inventory, registered plus eligible, was 532 million ounces. Today it is 366 million ounces. That is a 31% decline in 5 months. Almost a third of the silver in those vaults has walked out the door. And in the registered category specifically, the silver that is actually deliverable, we have seen a 32% drop in 4 months. I want you to really sit with that number. A third of the deliverable silver at the most important commodities exchange in the Western world has disappeared in the time it takes to grow a beard. Now, where's it going? The answer matters enormously. It is going east. It is going to Shanghai. It is going to Hong Kong. It is going to Singapore and Tokyo. The Shanghai Gold Exchange has been trading physical silver at premiums of $8, $10, sometimes $12 above Western spot prices for months now. And in October of 2025, silver lease rates in London, the cost of borrowing physical silver spiked to 34.9% annualized. Let me put that in perspective for you. Normal silver lease rates are below 1%. They hit almost 35%. The cost of borrowing silver in London went up 3,500% because there was not enough physical metal in the London system to lend. When the cost of borrowing something spikes by 3,500%, that is not a blip. That is not a seasonal adjustment. That is a system screaming that it is running out of the real thing. And here's the number that ties all of this together into something that should genuinely alarm you. The COMEX coverage ratio right now is 13.4%. Let me explain what that means. For every 100 ounces of silver represented by paper contracts trading on the COMEX, only 13 ounces are actually sitting in a vault ready for delivery. 87 ounces out of every 100 exist only on paper. They are an IOU. They are a promise. And the people who actually work in the physical silver market, the dealers, the refiners, the mints, the guys who run their hands across cold silver bars every single day, those people know it. They have always known it. The paper market has always been a leverage game. But something has changed. The gap between the paper price and the physical reality has gotten so wide that the dealers are no longer willing to play along. And when they lock their websites, when they gray out the buy button, when they jack up premiums to $10 or $15 above spot, they are making a business decision that tells you everything. They are saying the replacement cost of their physical inventory is not $67. It is closer to $80, maybe $90. And they are not going to give you their silver at 67 when they know that is what it will cost them to restock. Let me walk you through the math of the delivery situation, because this is where the story gets genuinely urgent. The April 2026 futures contract has its first notice day coming up in 2 business days. As of right now, there are still 426 open contracts in that April delivery window. Each COMEX silver contract represents 5,000 ounces. That means we are looking at 8.63 million ounces of potential delivery demand in a single contract month. Against 88 million ounces of registered inventory, that is 9.7% of the entire deliverable stock being demanded in 1 month alone. And this is not the only month with open interest. When you look at the total open interest across all silver contracts, the paper leverage ratio is 7.5 to 1, 7.5 times more paper claims than deliverable metal. The math is not complicated. If 5% of contract holders decided to stand for delivery instead of rolling their positions, the system would crack. If 10% stood for delivery, it would break. And we have already seen delivery volumes that were previously unthinkable. December of 2025 saw 46.6 million ounces delivered, which represented about 50% of the estimated free float in registered inventory in a single month. January of 2026 saw somewhere between 33 and 40 million ounces delivered, which is 7 to 10 times the historical January average. The pace of delivery is accelerating while the inventory is declining. That is not a stable situation. That is a countdown. Let me do one more calculation live because I want you to hear every number. We have 88 million ounces of registered silver. The average withdrawal rate over the past few months has been running roughly 333,000 ounces per day. 88 million divided by 333,000 gives you approximately 264 calendar days at the current pace before the registered category hits 0. But here is the thing. The calculation assumes the withdrawal pace stays constant. It will not, because as the inventory gets smaller, the urgency to secure physical metal gets bigger. When the vaults start running low, the people who know the market front-run the exhaustion. They grab what is available before it is gone, which drains the inventory faster, which creates more urgency, which causes more front-running. It is a self-reinforcing spiral. The realistic estimate, accounting for acceleration, is closer to 163 trading days. That is roughly 8 months. And that assumes no April delivery spike, no geopolitical shock, no force majeure event that causes a rush. In reality, the system will seize up long before it reaches 0, because the market will see it coming and act. Now, I want to take a step back and give you 3 historical examples that tell you exactly how this story ends, because history does not repeat exactly, but it rhymes so loudly sometimes that you have to pay attention. The first example is 1971, August 15th to be precise. Richard Nixon went on national television and told the world that the United States was temporarily suspending the convertibility of the dollar into gold. That word temporarily has aged poorly, because that temporary measure is still in effect 55 years later. But here is what matters. At that moment, gold was fixed at $35 an ounce on paper. Foreign governments had been showing up at the U.S. Treasury with their dollars and asking for physical gold, and the vaults were running low. The coverage ratio was collapsing. The paper claim on gold, the dollar, had been massively overissued relative to the physical gold backing it. Sound familiar? So they changed the rules. They closed the gold window. And within a decade, gold went from $35 to $850 an ounce, a 2,400% increase in 10 years, because the paper fiction had to eventually match the physical reality. The second example is 2008. Everyone remembers the financial crisis, but most people think of it as a mortgage problem or a banking problem. At its core, it was a paper versus reality problem. The paper said mortgage-backed securities rated by IOEA were safe, stable, as good as treasury bonds. The physical reality, the actual houses, the actual borrowers, the actual default rates, told a completely different story. When the paper fiction collapsed, the entire global financial system came within hours of total failure. Hank Paulson, the Secretary of the Treasury of the United States of America, physically got down on one knee and begged Nancy Pelosi to pass the bailout legislation. That is what happens when paper promises meet physical reality in a large enough system. The third example is March 2020, and this one is directly about silver. When COVID hit and supply chains froze, the paper silver price actually crashed to $11 an ounce on the futures market. But in the physical world, you could not buy a single silver eagle for less than $20 to $25. Dealers sold out in hours. The wait times for delivery stretched into weeks. The paper market said silver was worth $11. The physical market said, try 30. Which price was right? The physical market. Within 18 months, the paper price had caught up, moving back above $25 as the futures market finally acknowledged what the physical market had already told you. The physical market is the leading indicator. The paper market is the lagging indicator, and the physical market is speaking right now through locked dealer websites and grayed out buy buttons, and it is saying the paper price is wrong again. Now let me connect all of this to the bigger picture, because the silver market does not exist in a vacuum. The United States national debt crossed $39 trillion on March 17th of this year, and it is growing at $7.23 billion per day, $301 million an hour, $5 million a minute, $83,000 every single second. The projected interest payments on that debt are expected to exceed $1 trillion in fiscal year 2026 alone. $1 trillion just in interest. That is more than the entire defense budget and triple what the government was paying in interest in 2020. Think about that. The government is now borrowing money specifically to pay the interest on money it already borrowed. That is the definition of a debt spiral. And debt spirals have historically ended only one of two ways. Either the debt gets inflated away through currency debasement or it defaults. In either scenario, the people holding paper assets take the hit. The people holding physical assets survive. Meanwhile, the BRICS nations are doing something very deliberate and very strategic. China's central bank has been accumulating gold every single month. India's silver ETF inflows are surging dramatically. The Shanghai Gold Exchange is pulling physical metal from London and New York at a pace that is systematically draining Western vaulting infrastructure. And they are not doing this because they saw a YouTube video or read a newsletter. They are doing it because they understand arithmetic. A $39 trillion debt growing at $7 billion a day, backed by a central bank that cannot raise rates without collapsing the housing market and cannot cut rates without reigniting inflation, is a currency that is under fundamental structural pressure. The Eastern central banks understand this. The Western dealers who are shutting their websites down on a Sunday understand this. The question is whether you understand it before Monday morning changes the math. Let me talk about the gold to silver ratio because it is one of the most powerful and underappreciated tools in precious metals analysis. Right now, that ratio sits at approximately 64 to 65. That means it takes about 64 ounces of silver to buy 1 ounce of gold at current prices. Historically, that ratio has ranged between 40 and 60 in normal conditions, but in major precious metals bull markets, it compresses dramatically. In 1980, at the peak of the last great silver run, it hit 15. 15 ounces of silver would buy you 1 ounce of gold. Gold right now, after pulling back from its all-time high of $5,062, reached in January of this year, sits at approximately $4,500. If the gold to silver ratio simply compressed to 30 to 1, which is well above historical extremes, silver would be at $150 an ounce. At 20 to 1, it is $225. At the historical extreme of 15 to 1, it is $300 an ounce. And those numbers assume gold stays exactly where it is right now. Gold is not going to stay where it is right now. The same forces driving silver, the debt accumulation, the BRICS, gold buying, the physical deficit, those forces are even more powerful in the gold market. If gold reaches $7,000, which multiple credible analysts have projected based on purchasing power parity and debt to GDP trajectories, and the ratio compresses to 20 to 1, silver goes to $350 an ounce. That is more than 5 times the current paper price. That is the world the dealers who are locking their doors today are already living in mentally. They are not thinking about $67. They are thinking about $100. They are thinking about $150. I also want to talk about the LME nickel squeeze in March of 2022 because it is the blueprint for what happens when a paper market finally collides with physical reality in a short squeeze scenario. The London Metal Exchange, one of the oldest and most respected commodities exchanges in the world, had a situation where the nickel price went from about $25,000 a ton to over $100,000 a ton in a single trading session. A 300% move in one day. And what did the LME do? They canceled trades. They literally reversed billions of dollars of completed transactions and told the market those deals never happened. They changed the rules in the middle of the game because the physical reality of the nickel market was about to expose the paper fiction in the most embarrassing and financially devastating way possible. They protected the short sellers, who were predominantly large financial institutions, at the expense of everyone who was long and right. And I am telling you with confidence, because the math demands it, that when silver does what nickel did, the same playbook will be deployed at the COMEX, force majeure declaration. Emergency settlement in cash at a price determined by the exchange, not the market. And if your silver exposure is through an ETF, a futures contract, or a pooled account at some bank, you will get the paper price, whatever they decide that is that day. But if you hold physical silver, if you have taken delivery, if the metal is in your possession, you get the real price, the physical price, the price the dealers are refusing to sell at today because they know it is going higher. I want to hear from you right now. Drop a comment below and tell me what you are seeing on the dealer websites this weekend. Have you tried to buy physical silver in the last 48 hours? Did you find a maintenance page, an out-of-stock notice, a premium that made your jaw drop? Tell me in the comments. We are building a real-time evidence base here at Silver Trends, documenting what the mainstream financial media refuses to cover, because this information is not being reported anywhere else. The COMEX vault drain is real. The lease rate spikes are real. The dealer lockdowns are real. And when you put them all together, the picture they form is unmistakable. The physical silver market is in a structural supply deficit for the 6th consecutive year. The coverage ratio is at historic lows, and the smart money in the physical space is positioning for a repricing event of historic proportions. Your comment helps other people in this community understand what is happening in real time. So drop it below and share this video with anyone who owns silver or is thinking about it. Because by the time Monday morning rolls around, the window may already be closing. There's a concept I want to leave you with, and I want you to really think about it carefully. There is a fundamental difference between a paper claim and a tangible asset. A paper claim is a promise. It is a promise from a counterparty, from a bank, from an exchange, from a government. And promises, as anyone who has paid attention to the last 20 years of financial history knows, get broken. They get broken when the math stops working. They get broken when it is convenient for the people who made them. They get broken when the vaults run dry and the only options left are default or devalue. A tangible asset is not a promise. A bar of silver sitting in your possession is not subject to counterparty risk. It does not have a force majeure clause. It is not going to send you a letter explaining that, due to extraordinary market conditions, your silver has been converted to a cash settlement at a price we have determined is fair. It is there, it is real, it is yours. And in a world where $39 trillion of national debt is growing at $83,000 per second, where the COMEX coverage ratio is 13.4%, where dealers are shutting their doors on a Sunday afternoon because they know the paper price is a fiction. The difference between a paper claim and a tangible asset is the difference between being whole and being wiped out. The digital screen offers a price. Only the physical market offers the asset. And right now, the physical market is telling you, through every action available to it, that the price on the screen is wrong and the repricing is coming. The window to act at Friday's closing price is shrinking with every hour that passes. That is the analysis. That is the data. That is what Silver Trends is here to do every single week, cut through the noise and show you the physical reality underneath the paper theater. Subscribe to the channel and hit the bell notification so you do not miss the follow-up analysis as this situation develops, because this is a story that is going to move fast. Share this video right now with one person who needs to hear it before Monday. One share could genuinely change someone's financial trajectory. And drop your comment below telling me what you are seeing at the dealers this weekend. The physical market is speaking. The question is whether you are listening.